crude, that's the niggling worry that continues to circle around the $70 per barrel mark. Let's understand what could this mean and how is the underperformance in OMCs really going to play out. Mubina joins in. Mubina, tell us, how are OMCs typically going to get impacted now with crude at 70?
Well, for one, we have seen crude in fact slip below the $70 per barrel mark yet again, so there seems to be a lot of volatility over there. Nevertheless, crude still of course has been on an uptick for the last couple of weeks. What exactly has caused this OMC underperformance? Well, it's just that the rise in crude prices. Remember that while Brent was of course at the low point, we had seen oil prices actually, we had seen OMCs rather rally quite a bit in the year 2016, 2017 as well, part of it. But of course in 2018 there's been a significant fall. In fact, OMCs have fallen about 19 to 24%, from the recent highs. Now, remember that every $1 change in marketing margins impacts earnings by a good 12.9 to 13.5%. In turn, a rise in crude prices, of course, will as well impact the gross refining margins or GRM. So naturally, that is something that's going to hit the profitability as well. Of course, you must understand that now there is direct pass-through of any sort of movement in crude prices. Nevertheless, marketing margins and GRMs are still hurt whenever crude prices rise. Now, the street is anticipating marketing margins to increase, thus the EPS cut, and of course, it's something that will as well lead to increasing working capital requirements led by, of course, higher crude prices. And additionally, of course, there's also the capital allocation plan, which will essentially get impacted on proposed PSU consolidation. So this is as well a factor that is further putting pressure on OMCs. IOC, BPCL, HPCL, for the last couple of sessions, they have found themselves at the bottom of the nifty losers list. And I guess with crude prices being on the boil, while the oil producers and the upstream companies have been gaining, it's the OMCs now which will find themselves out of favor.
Okay, OMCs are out of favor, but in an ideal scenario, OMC should actually be in a sweet spot because fuel prices in India have been decontrolled, and if at all, GRMs are likely to go higher, and companies could also report a huge uptick in their inventory gains. So why are markets suddenly giving a stepmotherly treatments to OMCs? And if crude is on a boil, what else will change for the other oil producers and E&P companies like ONGC, Oil India and GAIL? So let's take that point forward with Mr. R.S. Sharma, former Chairman and Managing Director of ONGC. Along with him, we've got Harshvardhan Dole, I beg your pardon, Vice President with IFL. Gentlemen, good morning to both of you and thank you for joining us. Mr. Sharma, let me just address a very simple fact here. Oil prices in India at retail level are completely decontrolled, which means if crude prices go higher, you'll have to pay more. If crude prices go lower, you will have to pay less. And I guess government has really followed this in the true spirit of deregulation. There has been no government intervention whatsoever. So do you think this nervousness which currently has emerged in the market, that the deregulation process will be stalled because state elections are nearing and we have a big general election in 2019, is a false belief?
Well, Nikunj, your apprehension has taken words from me. And look, these markets move by sentiments as well, you know very well. And as the crude prices rise, the apprehension goes up that in course of time, whether the government will be able to maintain this deregulated scenario, or there could be some sort of subsidy regime again coming back. That is the worry, and that disturbs or spooks the sentiments about the OMCs. And just I like to correct one thing in the briefing which you said. The GRMs also depend on benchmark are not crude prices, benchmark are the product prices and the international parity with the product prices, which move in tandem with the crude prices, of course. So if the crude prices are rising, and you rightly said in that case, that product prices also rise, then GRM should also proportionately improve. So it's not that the crude price is rising that the GRMs come under pressure. Rather, on the contrary, the OMCs in the free market scenarios, they should have a more comfort in terms of the GRMs. It is the sentiments that going forward, the elections coming, whether the government will be able to maintain the status quo, and that's the worry, and that perhaps disturbs the sentiments about the OMCs.
Harshvardhan, do you concur with Mr. Sharma, or do you think one should get realistic about the political compulsions? Yes, the oil marketing companies, they have enjoyed benefits of a deregulation, but that they enjoyed when oil prices were in a downturn. Now the cycle has reversed. Policy could also be changed.
I think the situation seems to be manageable unless crude oil prices move out vertically to maybe $80–85 a barrel. If there is a calibrated movement in the crude oil prices, the situation seems to be quite manageable, and I expect that to continue. But having said that, let's be realistic. Tomorrow if crude goes vertically up to say $85 a barrel, and if that triggers basically a 12 to 13 rupees increase in petrol diesel prices, let's be realistic, this kind of volatility one cannot expect even in the most developed markets. And considering the Indian situation where the economy is kind of just bottoming out, such kind of shocks no government would ever would want to put forth. Having said that, the government would have to balance out its own finances and the inflationary impact of the fuel prices. So I think it's not going to be easy. It's going to be tight, walking on a tight rope. And to that extent, the concerns of investors seem to be justified, considering the fact that you seem to have elections coming in this year, and volatility in the crude oil prices is not something that either the investors or the essentially the finance ministry would consider in the base case scenario. But thus far the government has been pragmatic. They have actually given a free hand to the oil marketing companies to pass on bulk of the volatility, spare some period during December, and in case there has been shortfall in terms of the normalized marketing margins, they have been proactive to let them recover in the later period of time. So thus far the situation is not alarming. But if crude goes to 85 in a very short span of time, situation could actually be worse off.
Mr. Sharma, some analysts believe that we've seen some recovery in marketing and refining margins of OMCs lately and should see better numbers in the fourth quarter compared to what we have previously seen. And since the market is, a dynamics and duo of both earnings visibility as well as valuation, a few also think that there could be inventory gains. How better do you think earnings will be on a sequential basis for OMCs? Harsh, the same question to you.
During the fourth quarter, the volumes for the products have been fairly strong. In fact, if you recall last year, because of impact of demonetization, the key petroleum products had seen a decline in consumption. This year the case has been exactly the opposite. LPG is fairly strong, so is case with auto fuels. Lubricants are doing reasonably well, and the marketing margins as we analysts track have seen a sharp uptick. So on the marketing side, one should not be concerned as to whether the numbers will be weakish or otherwise. Refinery margin too have continued to be fairly strong, with the product cracks especially on the diesel side remaining fairly healthy. So in fact, fourth quarter should be one of the best quarters for the oil marketing companies if you look at the performance of these companies in the first 3 quarters. So fourth quarter should be one of the better quarters for the oil marketing companies put together.
And then, yeah.
A microfinance company which became a bank, and now they're going public. It's a big day for any promoter when you become listed, and there you can see Mr. Ghosh there. I can spot few merchant bankers, and I can also spot Ashish Chauhan, the CEO of Bombay Stock Exchange. So our camera view is getting slightly obstructed, but maybe we'll get a clear view. The pre-open rates indicating that this could be a cracking of a listing. I mean, given that what's happened to other IPOs of late, Bandhan Bank could be in for cracking of a listing. It's a very unique proposition because it's a microfinance company which has become a bank. So in terms of the client, in terms of their borrowers list, they have a very unique proposition and a very unique advantage. The ratios are enviable, the return ratios and return on asset again is very, very different than other banks. Of course, the base effect would kick in here, and when they migrate into being a bigger bank, that will come at an expense. But 2-3 quarters of migration has already kicked in, and markets know that the progress so far has been strong. So you may see institutional activity in Bandhan Bank because there is going to be a scarcity premium which this bank would have to offer. Because if you look at Equitas or other companies which have migrated to become a bank, they got listed first and then they became a bank, and numbers they came down. But with Bandhan Bank, it was a microfinance company which became a bank and then it went for listing. So that's a differentiating factor. It is a good listing. It is a smart listing. It's a listing given the market conditions we are in. 25% uptick is quite commendable. Let's see where the stock settles, but I expect that the stock is going to remain charged up for the rest of the day. Mr. Sharma, the other issue which is bothering markets is that what is government trying to do with their cross ownership? HPCL is now part of ONGC. GAIL will be part of IOC. Now, theoretically, if you're a shareholder of ONGC, you would say, look, I'm getting HPCL, I'm getting HPCL at a premium to market price, and if you're a shareholder of HPCL, you would say that why should I be merged with ONGC?
Well, personally, I feel this is a Nikunja win-win deal for ONGC as well as HPCL. So far as ONGC is concerned, in one stroke, ONGC, through this inorganic growth, ONGC becomes a fully integrated company. And let me share with you, this is the aspiration ONGC has been having since I was the CFO. I will go back 15 years when we had acquired MRPL. That time we had also conveyed that we would like to acquire HPCL. That was not agreed to. But I feel this is a good opportunity, and going forward, and you would have seen that 37,500 crore paid by ONGC has not impacted its liquidity. ONGC has a very, very strong balance sheet, more than 200 lakh crore net worth of the company, virtually nil borrowing. So that is the advantage to ONGC and to HPCL. Take it. Earlier, that were owned by government, they were never able to leverage the owners, the guarantee in case of need, because government doesn't, as a matter of policy, give sovereign guarantee. But they will be able to leverage ONGC balance sheet in case of borrowings, in case of expansion. ONGC would be willing to give that corporate guarantee to HPCL, and the HPCL's credit rating would go up. So I feel it's win-win for both of them, and the structure that has been done, it is not a merger. It is just getting controlling stake by ONGC, and if you look, the management of HPCL has not been disturbed. The CMD remains CMD, entire management remains the same. Only ONGC has 2 nominee directors on the board. Perhaps this is the structure. I recall ET Now had done a webinar after the last budget where I had categorically told that this should be the structure, this should be the modality. I am very happy it has been implemented the same way. Now coming to the GAIL, I know that IOC as well as BPC both have conveyed intent that they would acquire controlling stake, and there were some media reports government may decide to give 50-50, and I have gone on record to say that 50-50 does not help either IOC or BPCL. For them, it will remain a portfolio investment. It will make sense to IOC or to BPCL only if they are getting a controlling stake, and they get GAIL as a subsidiary. So if IOC is getting entire GAIL as subsidiary, that makes a lot of sense to IOC or to BPCL. Not 50-50 is not the structure. Probably it will be agreed by any of the entities.
Okay, fair point. Harshvardhan, wanted to get your take as well on the same, because the government believes cross-stake purchases in oil and gas companies like ONGC, HPCL deal will create integrated energy companies. Now, reports are indicating that BPCL and IOC may pick up government's majority stake in GAIL. Aren't these two separate businesses, hence providing little synergies, but benefiting the government's divestment kitty more? And also, will cross-stake purchases by state-owned oil and gas majors in each other upset valuations further, in fact, than bettering the situation?
No, I completely agree with your view that some of these M&A deals which have happened have logically no synergies. Say for example, ONGC and HPCL deal that helps the government kitty much more than either the minority shareholders of either ONGC or HPCL. In fact, that has kind of the whole deal has kind of derated the entire sector. We have seen HPCL stock valuations from what they were at the time of the deal versus what they are now, and same has kind of been mirrored with IOCL as well as BPCL. I think had the whole M&A been done in a much more transparent manner, the valuations had got a substantial boost. But having said that, one should also bear in mind, these entities are into businesses which are fundamentally sound. They generate heaps of cash, and these investors would look through some of these knee-jerk reactions and the corrections in the stock prices beyond maybe 1 to 3 months. And if one takes maybe 3-year plus view, some of these stocks are screaming buys now. So for example, all the OMC stocks after recent corrections, these are available at less than 7-8 PEs. And mind you, for all the 3 OMCs, more than 50% of the earnings come from marketing business, which has got substantially strong entry barriers. These marketing entities generate more than 20% ROEs, and they have never diluted equity to for either for business expansion or to kind of do some M&A activity. So fundamentally, these are sound businesses, and the investors, the value investors, will look through some of these corrections as a deep opportunity to buy these stocks rather than panicking and sell at this juncture.
Mr. Sharma as well as Harshvardhan, thank you so much, both of you, for taking the time out and speaking with us and really helping us understand how to play the dynamics of OMCs and what should really investors watch out for when it comes to the sector, be it the crude spiral up or the government's intention to merge some of these companies and create a larger conglomerate of an OMC.